This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now as we take a look at the market trade action we saw on Tuesday, we welcome in Brian Splitt of agmarket.net. Brian, great to catch up with you again, sir. How are you?
I am very good. Always good to be here, Jesse.
Thanks for the time, Brian. Let's dive right in. We saw a little bit of risk on momentum early on Tuesday's session after we've been seeing the markets just taking a beating with the dollar screaming higher. But even then, we kind of saw the dollar come off of its lows, and then we saw commodities come off their highs on Tuesday. Felt like a little bit of seesaw trade action. I know just everything going on with the macro markets and especially that dollar and other currencies. There's a lot going on in the trade right now, a lot of volatility. But as I mentioned, Tuesday just kind of felt like a little bit of a back and forth seesaw trade action, Brian.
Yeah, I think when you look at corn and soybeans, both of those found buying late in the day yesterday and overnight where they should have. So thinking about corn, we've got the long-term uptrend that is drawn off of the July lows. That comes in just below the 100-day moving average, which is where the trade bought it yesterday and overnight. Did see a good bounce off of that, like you'd mentioned, and it was actually right at 9:30 this morning. Corn rallied about 6 cents in just a matter of a few minutes. Beans rallied 5 or 6 cents. I think wheat rallied 10 or 15 cents in a very short period of time. So somebody came in at 9:30 and bought a few of each of different things. And then we just spent the rest of the day after that little buying burst just kind of filling back, and beans made new lows late in the day. Corn was just a couple cents off the lows. So one of the things that we've been looking at, we do have this report at the end of the week, and we have not had spot soybeans or front month soybeans below $14 since January after getting back over $14. So when you think about the implications of this report Friday, I think if we do see November soybeans below 14, that would be a very negative development on the chart. So we've been advising having some kind of put coverage for producers that don't want to sell beans yet or want to see their yields prior to making their sales. Much the same when you think about that uptrend in corn and these moving averages. 670 come Friday's close is going to be a very important spot. And I think if we're below 670, then that's going to look negative on the chart.
Well, and you mentioned those 100-day moving averages and the report coming up on Friday, and I think that is definitely key, especially as well when you throw in everything going on with the dollar and other currencies. And one has to wonder, as you look at the chart, you mentioned some there a little bit, but one has to wonder, can we hold up at these 100-day moving averages with the constant pressure from this U.S. dollar? How long can we hold these averages, Brian?
Yeah, I mean, you've got the dollar. So just you think back to the trade last week when the Fed raised interest rates, and the dollar was trading just above 310 or 110 at that point. We're trading up around 114 and some change. And I think when you look at the consolidation that we had over the last year or so on the dollar and breaking out of that consolidation, those measurements look up to about 117.50 or so. So we could still have some further strength in the dollar. Now, when you look at commodities and you look at corn and soybeans specifically, our exports are not good for corn. So that's no secret. We're running about half of the pace we were this time last year. Our inspections on soybeans, and I know it's very early in the marketing year, but that looks to be a bit of a concern, especially now we just had Argentina sell a bunch of beans to the Chinese. So do the Chinese even need to come here for OND type business? And then that's just going to be followed up by Brazil's crop. And if we plant the Brazilian crop in decent weather and we don't have any major weather concerns, the trade's going to get more and more confident on the idea that we could have 150 plus million ton crop there. If that type of crop is realized, our exports maybe non-existent for the next 6 to 8 months. So that's something that producers have to be mindful of. And when we are using strategies to cover next year's price levels as well.
Yeah, because you brought up exports there as well, and it feels like this market is kind of turning into demand destruction mode almost, Brian. When you think about the way exports are and the high dollar and other high values around the world, I know the British pound. We were talking about that off air, falling apart here this week as well. China's economy, et cetera, et cetera. It feels like a little bit of demand destruction is kind of coming in here across the entire ag space, whether we're talking grains, oil seeds, livestock, et cetera, et cetera. Doesn't it feel like a little bit of demand destruction right now?
It does. And so we cover the exports. I think something, too, that people have to realize when they're thinking demand destruction, it's very easy to look at the futures board and say, oh, well, futures are 670. We saw prices get to 7 plus. Are we rationing demand at these levels? But don't think about the futures board. Think about the cash price that's out there.
Hmm.
That's what's rationing demand right now. And so I think that when you think about the basis levels that we have in cash values, those are price levels in the cash market that should be rationing demand. So I think we're seeing it in the cash market. I think that's showing up in our exports. And so now what's left, we're going to be thinking about the type of animals that we're feeding, how many are on feed right now. Are we rationing demand there? And then, of course, ethanol for corn. I think right now with where meal is, we're going to continue to see good demand from the crusher with where the board crush is. So unless we really start to see the products back off, that's probably going to continue to be a bright spot on the soybean demand side.
Yeah, and you mentioned the cash side. I know we have some pretty strong bases still regionally, and which is something that typically this time of year we got to think as well seasonally with the harvest pressure. I know some of the early yields we've been hearing quarter bean wise across the country have been pretty good. So thinking about cash kind of supporting things a little bit right now. How long can that hold up regionally with all this harvest pressure that we would typically get in the market this time of year, Brian?
Yeah, I mean, something we have to remember is the crop is a couple weeks behind. So we're used to getting harvest pressure a little bit earlier, seeing the basis moves because of that a little bit earlier. The USDA progress report yesterday still has harvest a little bit behind what the trade was looking for. So I don't think we're getting really into the gut slot of that harvest pressure quite yet, but I would expect some basis movements to come. And so I think one of the things we're looking at on soybeans is, again, if you have beans and you don't want to price them yet because you want to see what they're yielding, again, we're advising keeping puts at that $14 level to make sure you've got a floor under it while you're figuring that out. Once you know where you're at, you probably should be looking at selling the beans out of the field, storing the corn. And if you want to have some kind of participation in soybeans in case there is a South American weather event, then build some kind of a March option strategy. Take the risk, off the flat price, buy your call spread or call or whatever you're going to do, pay what you pay for it. That's your maximum risk. And then go from there and call it a day and then work on your corn marketing.
Brian, let's talk about the wheat markets a little bit. They had a decent day on Tuesday, double digit gains at the close, although we were off the high. Winter wheat planting is advancing, although I've heard some reports, some growers are dusting stuff in because it's still very dry in the southern plains. Look at support levels. I think, KC wheat especially has got some support at the 20-day at 924 last I looked, and a little bit of resistance overhead around 984. What's your thoughts in this wheat market as we kind of look at things here in the broader backdrop of what's going on in the markets right now?
So the wheat to me, and I've been kind of focused on this hard red, so the Kansas City variety wheat. I am using the monthly continuous chart as our guide. And one thing I think is uncanny is the way that we're trading and how close we're trading to 2008. So in 2008, we had made a high that was, I believe, 1374 and three quarters or 84 and three quarters or something like that. This year it was just a nickel off that high. And then from there we came down, and 4 months after making that high, we tested $8, which we did last month. So now we're in the fifth month after making that high. In 08, we made a high of 988 and a quarter for that fifth month. We just made a high in KC wheat this week of 989 and three quarters. So what this would suggest is if we continue to follow this pattern, we're going to go right back down again into October, which would be the 6th month after making the high. And we're going to revisit the lower 8s again. Now, if we do that, and if this pattern holds true, I think that's, again, a very good buying opportunity on KC wheat in the low to mid 8s, looking for a pump back up to 950 again. And that might be your last selling opportunity on new crop wheat. So I think if we do see some highs again around 950 in the front month contract in the month of November, that's where I want to be selling the July 23 contract and start looking at some marketing for next year's wheat, or the wheat that's being drilled right now. And I don't know what the case was here, what might lead us to this, but in 08, we found ourselves down to about $6. And so that would, timing wise, if we hold on to the similarities from 08, that would put us in that January timeframe of having this market back down around 6. And so I think if there's some opportunity to sell some 950 plus wheat for next year, we should be jumping on that in the next couple months.
Brian, let's switch gears and talk the livestock markets. Livestock started Tuesday trying to trade higher with the dollar breaking a bit, but then we quickly we lost that upward momentum. Hogs have just been taking a beating here the last couple of sessions. More triple-digit losses on Tuesday. As you look at this hog market, is this looking like maybe a longer term correction in hogs here? And I would have to think, hogs keep going lower. That could at least maybe help out at the retail counter.
Right. So, we're going to be getting into earnings season, and anything protein related from the food sector is going to be something that's paying attention to corporate earnings. When we think about, the chart right now, and this is something we just looked at this last week and in our weekly webinar that we do on Wednesdays. We looked at both live cattle, lean hogs, and feeder cattle. Feeder cattle are the ones that showed a top first. They have a head and shoulder top. This October contract still projects down to about 171 for the measurement. Now, live cattle made a double top. Those two highs were made almost exactly 5 months apart. So last Wednesday, we were looking at, hey, you probably should be buying some 148 puts. They were going for about $2 at that point. Because if we took out 148, we took out the most recent set of lows on a monthly basis, and we took out the uptrend, which we've done. So now we have to get back over about 148.50 in order to turn the chart back to neutral to positive. I think we're going 144. That's what that measurement would suggest we're going to for a downside target. And then you look at lean hogs. We looked at that last week as well. There's a head and shoulder top there. The recommendation was buy puts at 80 to 82. Those were going for 80s were going for less than $2 to 82s were going for a hair over $2. Once we got on the other side of 80, it was death to Smoochie there. That projects down to about 71.50. So I still think we've got some lower lows to come yet in all of the livestock over the next couple weeks.
Brian, I know Hogs and Pigs report coming up on Thursday. Do you think that could maybe give some support? I believe private estimates are saying inventory expected to be roughly about 1.5% lower. I just wonder if that does happen, how much support could that give to hogs in the broader scope of things?
Well, based on the scope of the move that we've had and the amount that we've fallen off the highs, if there is a friendly report, we could very easily bounce from that. This December contract really needs to get back over that 80 to 81 zone in order to, again, turn it into a more of a neutral to slightly friendly look. But again, this is a very clear pattern, and getting through 80 was a very big deal on the chart. And I'd be surprised if this market didn't go take a look at the low 70s first before getting a more meaningful bounce.
Right. On the cattle side as well, and this kind of ties back in maybe to the corn market too. We're thinking about feed costs, et cetera. And a lot of chatter about, will we have to try and move some corn, some feed from, say, the eastern states to the feedlot country in the Southwest, just with the lack of corn there? I wonder how that's going to impact margins for our cattle guys there in parts of the Southwestern plains as we move in here into the back half of the year.
Oh, yeah, without a doubt. I mean, you're going to have some kind of a pull in order to get corn from states where it's available to where there's a severe deficit. So, the deficit in the Southwest is you're going to have corn pulled into that region for feed needs. And that's going to be a product of basis in areas. It's going to, work. That's the job of the market, is to get corn from where it is to where it needs to be. And so you're going to see different things happening with freight rates, all that stuff. It's going to be, I don't envy the merchandiser at this point, put it that way, because there's an awful lot of moving parts right now.
Brian, just on the outside macro markets as well, a little bit more. Love to just let you expand your thoughts here on everything going with the dollar and some of the other issues we're seeing with currencies worldwide. I know a lot of talk about this. The Fed still kind of keeping their hawkish stance here and raising rates and talking about another rate coming up yet here when we get to I believe November. With this dollar and everything else and watching currencies worldwide, I just know that it seems like this is going to be a wet blanket over everything until we get some things under control here with inflation.
Yeah, I mean, I think there's more and more talk about, how we need to see interest rates go to the rate of inflation in order to really curb inflation. So we're not there yet. That would suggest that even if inflation slows down a little bit, we probably still need to see rates get to 6.5 or so. When you think about the currencies, this British pound move that we had coming out of the weekend and CME Group halting trade there, there's a lot of big movements happening in currencies, and that's really important. When you think about the plumbing in the world financial system, if you get something to break there in the financial plumbing, and you think back in 2008, it was Lehman Brothers, and so I think Credit Suisse is another name that you need to watch right now. Some of the default bond swaps right now are very close to levels that we saw on Lehman Brothers before they went down. So there's things that are happening out there which you have to understand can impact corn and soybeans. If the funds are long a couple 100,000 contracts of corn, and all of a sudden something happens in the financial system and they just don't want to be long anymore, that's a lot of contracts they need to sell. And so it may not have anything to do with the balance sheet that knocks this market off these highs. It could be just overall macroeconomic money flow. And so that's, to me, is a reason in and of itself to, at the very least, carry puts under bushels you haven't priced yet, and still hope that the bullish fundamentals win out over the long run.
It's definitely about risk management. That is for sure. Any worries about Hurricane Ian impacting the Southeast? I know it's going through some fertilizer production areas for the U.S. Do you think that would have any major impacts for the market here as we move forward, or do you think it might just be short term? Depending on, I guess it would depend on what we see for any destruction in the hurricane's path.
Yeah, I mean, of course, the damage is possible. You think back to a year ago and the type of damage that was done to export facilities and the amount of time it took to repair those facilities and get us back online. Could there be a short-term impact? Absolutely. Could it be a longer-term impact that takes more of a toll on fertilizer production? Yeah, it's possible. It really just depends on how much damage is done. And I think the market will be watching the landfall maps and trying to figure out where it looks like it's going and what that's going to impact. But it's really hard to tell what the long-term ramifications are until we see what kind of damage is done, if at
Well,
all.
Brian, we always appreciate your insight and analysis. And I know in volatile markets like this, it comes down to risk management. And you mentioned quite a few things that you guys are recommending. If producers need some more advice, they want to talk to you and the team there at agmarket.net individually and talk about their situation. I know you guys have a lot of great resources, a lot of ways to get in touch with you. What's the best way to get a hold of you guys?
844-4AG Market is our general line. So 844-424-6758. You can reach me directly at 815-665-0463 and check out the website, www.agmarket.net.
Brian, always a pleasure to chat with you, and great stuff as always. Thanks for the time. Enjoy the rest of your week, and we'll talk to you again real soon.
Thank you, Jesse. Appreciate it.
Brian Splitt with agmarket.net. That's going to do it for Market Talk here today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.